Hello, Ryan Reel, Senior Residential Specialist with the Wanabo Real Estate Group. All right, let's dig into the housing market. This is recorded on Tuesday, April 21st. So let's take a look at the housing market. We have the potential recession. We have massive amount of unemployment, and all this is going on with the coronavirus. Let's take a look and see what the reliable sources in the industry and in the financial system are saying. Let's take a look at what the science and the numbers are saying. Let's see where we're at and where we're projected to go. Time and date stamp, again, recorded on Tuesday, April 21st. All right, let's get to it. All right, everybody, a few notes as we get started. First, created and recorded on the evening of Monday, April 20th. It is released on the morning of Tuesday, April 21st. It is important to timestamp and date these due to the rapid day-by-day nature of the market. Special thanks to Steve Harney over at Keeping Current Matters, him and his crew, outstanding. Tom Ferry, his coaching group, outstanding. They are a large source of the graphs, charts, and research that we're going to show here. Methodology, very simple. We're looking for long-term and reliable resources for market information and analysis, as well as the science behind their analysis. Those are just some of the organizations, institutions, companies that we look at when they put out information. So a disclaimer, first, nobody can give you perfect advice. If anybody tells you they can, run away from them and do it quickly. Everything that you're going to see here is based on what we see taking place in the market. This is also what the science has to say about it. So based on all of the above, the following is the best advice I can give you today. All right, so what about home values? Big take-home message. A recession does not equal a housing crisis. So what were some of the big contributing factors to the housing crash? Lenders making predatory loans, handing out money very, very easily to anybody. Buyers making ridiculous purchases, overbuilt markets, home equity positions. Those are the big four right there. There were others, obviously. But let's take a look and see, where are we today compared to where we were going into 2008, 2009. Housing is a foundational element of every person's well-being, and with nearly a fifth of the U.S. gross domestic product, GDP, rooted in housing-related expenditures, it is also critical to the well-being of our broader economy. Quote from Harvard. Many still bear scars from the Great Recession and may expect the housing market to follow a similar trajectory in response to the coronavirus outbreak. There are distinct differences that indicate the housing market may follow a much different path. While housing led the recession in 2008-2009, this time it may be poised to bring us out of it. Right? Chief economist for First American Financial. With the exception of two recessions, the Great Recession from 07 to 09 and the Gulf War recession from 90 to 91, no other recessions have impacted the U.S. housing market, according to Freddie Mac Home Price Index data collected from 1975 to 2018. It's National Association of Home Builders. So what about months of inventory? How many homes are for sale? All right, so let me orient you on this. Months worth of inventory. If we stop taking new listings, divide the amount of time it takes to sell them, that gives us how many months worth of inventory we have. How many months it would take us to sell everything we currently have if we took no new listings. 7 months or more, buyer's market. 6 months is neutral. Nationally, which is what the graph is, 6 months or less is a seller's market. In San Diego, we know that it's 4 months or less. So if we look and see 2006 to 2011, 2012, massive number of homes for sale. Overbuilt, too many homes. The supply was phenomenal. If we take a look where we are today, we're down in the 3% range. 3 months range. Very big difference. Simple supply and demand. In 2007, we had 8.2 months worth of inventory. Today, we have nationally 3.1 months. In San Diego, we're well under that. There are some zip codes in San Diego that are under 1 month worth of inventory. That is a sign of a very strong market, or what could be a very strong market. What about home appreciation rates? If you look at the graph in red, 6 years leading into the housing crash, those are absurd appreciation rates. 12.5% a year. And, it was overbuilt. There was not a lack of supply. If we look at the last 6 years, 2014 through 2019, we see far more reasonable numbers. The best year from the last 6, 2017 at 6.4% appreciation, doesn't even break. It wouldn't replace any of those as being worse. It's under the best year, it's under the worst year of 2001. It's a big difference in appreciation rates. Home equity is another big deal. From 2005 to 7, the Americans cashed out $824 billion of their home equity to finance lifestyle. 2017 to 19, we apparently learned our lesson. $232 billion. There's a big difference in equity position. Right? The chief economist at CoreLogic, our home equity report found that at the start of 2020, homeowners with a mortgage had an average equity of $177,000. $177,000. That's a big difference. The last slide, remember the billions of dollars of equity that were removed there? That's not the case anymore. It's not the case. So if we end up in a far bigger recession, are people going to walk away from their homes for $177,000? Are they going to walk away from that? No. What if the housing market took a 25% hit, 5% more than 2008, 2009? That 177 goes down to about 132,000, 133,000. People aren't walking away from that. Short sales, not coming. Not like we've seen them before. 53.8% of homes in the United States have at least 50% equity. That means the owner owns outright more than half the property. 37% of them, they're owned outright, free and clear, no mortgage. 26.7% of the mortgaged homes have at least 50% equity. That's a big deal. Big difference. What about the lender side? 2006 on the left side, right? We're looking at the mortgage credit availability index. How easy is it to get money? The higher the number, the easier it is. 2006, it was 868.7. This was buyers making bad decisions and lenders making even worse decisions, and some of them being predatory. When a kindergarten teacher can walk into a bank and tell a lender, I make $150,000 a year and I would like to buy a $5 million house, and they say, no problem, sign here. That's what we had in 2006. Today, the number is at 181. It's a lot more difficult to get a loan, especially over the last couple of weeks. Percentage of median income needed to purchase a median-priced home. In 2006, it required 25% of your income to buy a home, the median-priced home. Today, it's at 14.8. It's a big difference there. So what about home values in recessions? During the last 5 recessions, here's what we saw. 6.1% appreciation in 1980. 3.5% appreciation in 1981. 91, we had a 2% drop. 2001, we appreciated 6.6%. And we took a bath in 2008. Quote from Ivy Zellman, supported by our analysis of home price dynamics through cycles and other periods of economic and housing disruption, we expect the home price appreciation to decelerate from current levels in 2020, though easily remain in the positive territory year over year, given the beneficial factors of record low inventories and a historically low interest rate environment. It's good news. So what are the projections? Here we go. Pre-COVID, post-COVID. So in 2020, the pre-COVID projections, 4.7% appreciation. Now that the COVID virus is here, it's been downgraded to 3%. Okay. Not ideal, not bad, not ideal. 2021 was originally projected at 3.8%. That's been upgraded now, 4.2%. There were no pre-COVID predictions for 2022, but now we do have them post-COVID. There you go. That's the effect, projected effect, of the coronavirus pandemic on housing. So based on what we see, know, and what the science says about the housing market, we know that there are far fewer homes for sale. We know that the appreciation rates are far more under control. We know that homeowners have a far better home equity position. And we know that the mortgage credit availability index is a lot more reasonable. Home value predictions was on the last slide. That's good news. So based on what we see, know, and what the science says, the housing market largely led the way in 2008, 2009. In 2020, the housing market is positioned to lead the way out of the coronavirus recession in Q3 and Q4 into 2021. That's good news. All right, well, there you go. There's the housing market. That's the best advice that I can possibly give you as of the day and time, Tuesday, April 21st, that this was recorded. This was part of a longer video that covered what's going on the ground with the real estate market in real time. Got into the recession, unemployment, obviously this part with the housing, and then there's an executive summary. If you guys want to check that out, it's housed over there on the YouTube channel. Address just came through. If you guys have any questions or concerns, something more specific to you, would love to have the opportunity to hop on a Zoom call with you, answer whatever questions you may have. Call, text, and email works just fine also. Hope you guys have a great rest of the day. Take care.